Good day. My name is David Wild, and this is the second part of a three-part lecture on control, performance, and quality on Chapter 17 from Connect Master Management 2.0. There are many different ways that organizations exert control. Some of the tools are geared for certain functional activities of the business, their financial operations, their operational aspects, marketing, etc. Within the domain of financial controls, there are a number of ratios that managers use to evaluate the health of the organization. There are also instruments managers use to establish controls. First, let's talk about functional control mechanisms. Businesses rely on a number of functional areas to establish control of the organization in general. Financial and accounting professionals play a major role in establishing budgetary controls and preparing financial statements for organizational control. However, control isn't only the responsibility of financial managers and accountants. Various functional areas of an organization take part in ensuring its overall health and effectiveness. Budgetary controls. Financial and accounting experts in an organization will help departments and even teams set budgets to make sure they are performing well. Expense budgets set anticipated expenses for a specific business unit or division for the coming year, and then actual expenses can be compared against the budget. Cost centers in an organization are groups like information systems or human resources, and such groups are not directly responsible for generating revenue. However, because they incur cost, they will also be given expense budgets for the year. Managers will look at actual expenses throughout the year to determine if they are on track to meet a budget or determine that they might be at risk of being over budget. Some organizations have adopted what is called zero-based budgeting, which means the budget items need to be justified and set anew each year in an attempt to reduce cost. This means that each employee and every expenditure need to be justified to management. Revenue budgets focus on developing forecasts to determine if actual revenues are satisfactory. These budgets are the mirror image of expense budgets. Managers use other budgets besides expense and revenue budgets to monitor and to control spending. Cash budgets are used to ensure that the organization has ample funds on hand to meet its needs and any emergencies that might arise. These budgets capture anticipated receipts and expenditures of money that represent cash inflows and outflows. Companies also develop capital budgets for their major investments in plants, buildings, and equipment. These outlays can be quite substantial for large manufacturers. Now let's talk briefly about financial statements. Expense, revenue, cash, and capital budgets allow managers to consider whether their current decisions and activities are appropriate relative to forecast that the organization sets. There are also two types of financial statements that allow managers to determine if an organization is healthy and if it has performed well in the past: balance sheets and income statements. An example of a balance sheet is shown on the slide in front of you in Table 2 from the text. A balance sheet lists the firm's assets, which include things like cash, land, and buildings. It also provides information on claims on these assets. Liabilities are what the firm owes to banks and to others, such as suppliers. The remainder, or assets minus liabilities, equals the owner's equity. Unlike the balance statement, which is about the current financial health of the business, the income statement is about how well the firm performed last year. Now, on the slide in front of you, you see Table 3 from the text, which is an example of an income statement. Another name for the income statement is the P&L, or profit and loss statement. Companies put together an income statement at least once a year, and publicly held companies do so more often, quarterly or every 3 months. The income statement starts by listing the firm's revenues or sales, and then it goes into various cost categories. Now let's talk about other types of functional control mechanisms. First, human resources controls. While financial and accounting managers play a very important role in organizational control, the other functions of an organization also have critical roles to play. Human resource specialists develop rules and procedures to protect the organization. When hiring employees, organizations might ask them to take personality tests or to be subject to drug tests. HR staff also administer surveys to employees to gauge the climate of the workplace and work-life balance. They can assess employees' competencies and put in place improvement plans for better effectiveness on the job. HR staff also develop policies for employee discipline and become involved in the resolution of disputes on the job. Next, there are information controls. Information technology professionals get involved in nearly all aspects of organizational control because they design the information systems that generate the raw data for producing financial and accounting information and other reports. These professionals are also responsible for providing data security to safeguard company information, as well as information on customers, suppliers, and other stakeholders. Next, we have corporate governance controls. Organizational controls are not only geared for lower level and mid-level employees, but also to senior executives. Corporate governance refers to the overall system of rules and practices by which a company is controlled. One of the main instruments of corporate governance is the board of directors, which exists to ensure that the company's senior executives behave in the interest of shareholders. Legal and compliance professionals work to ensure that the organization follows relevant laws and regulations. These regulations might relate to product safety or workplace regulations. Such departments in organizations also develop workplace codes of conduct and ensure that employees behave in accordance with professional codes of ethics. Finally, we have operations controls. The operations function of an organization takes the lead in enhancing efficiency and reducing waste in the organization. It also is actively involved in taking steps to improve the quality of the organization's products and processes. A popular and broad approach to achieving this aspect of organizational control is termed total quality management, and we'll talk more about that later in this chapter. Now let's talk a bit about financial ratio analysis. Financial tools of control are designed to measure and manage the profitability of a business. There are many determinants of firm profitability and even its survival, so there are many different measures that might be constructed. These are usually based on ratios, so managers, financial professionals, and investors engage in what is called ratio analysis. There are 4 different categories of ratios. First, we have activity ratios, and again, you can reference these different categories and actual financial ratios and how they are calculated by looking at Table 4 on your screen from the textbook. So let's talk activity ratios first. These are designed to gauge how efficient the organization is in using its assets. These are also sometimes called turnover ratios, and they are measures of the firm's productivity. As you can see, these types of ratios include asset turnover, receivables turnover, payables turnover, and inventory turnover. Second, we have liquidity ratios. These are designed to measure whether the organization can meet its short-term obligations to creditors. These include both the current and the cash ratios. Solvency ratios are related to liquidity ratios. but they focus on the firm's ability to meet its longer-term obligations. These include the debt-to-asset ratio, the debt-to-equity ratio, and the interest coverage ratio. The final category of financial ratios are profitability ratios. These are some of the most important ratios and help determine the firm's ability to earn an adequate return. These include the gross profit margin for the firm and the return on assets for the firm. Taken together, the four sets of ratios, activity or turnover ratios, liquidity, solvency, and profitability, are intended to provide insights into a company's strengths and weaknesses. Managers will examine these ratios over time to see where improvements or declines are evident. They will also compare a company's ratios with those of their key competitors to determine how the firm is superior to or inferior to other companies following different strategies. Finally, let's talk about other types of controls. When managers put in place organizational controls, they also need to make decisions about other types of controls. They need to consider whether to grant authority to lower-level managers or to control more decision-making from the top of the organization. They also need to consider whether to use controls other than financial controls to manage an organization. Finally, they can exert controls over inputs, behaviors, or outputs. One of the most important decisions managers make is to centralize the decision-making process versus granting decision-making authority to lower-level employees. Centralization is based on the idea that employees need to be coordinated and monitored. By contrast, decentralization gives more decision-making autonomy to lower-level managers. Managers need to decide whether to monitor employees' inputs, behaviors, or outcomes. Input controls protect organizational resources by specifying resources to which employees have access. When the actual activities of workers can be specified, managers will use behavioral controls, which indicate how the work will be done, where it will be done, and when it will be done. Finally, output controls focus monitoring attention on results rather than the inputs used or how the work is actually completed. So, in summary on talking about the types of control, many different types of control and control mechanisms are actually used by organizations. Different types of budgets are developed and used by managers, such as expense budgets, revenue budgets, cash budgets, and capital budgets. The balance sheet and income statement are two financial statements that allow managers to determine if the financial condition of an organization is healthy and whether it has performed well in the past. Other controls originate in different functional areas of the business, including human resources, information technology, or operations. Corporate governance controls are particularly geared to senior level managers, and legal and compliance controls are set by lawyers and compliance officers in most companies. Managers typically use four sets of financial ratios to determine if a firm is healthy. Activity ratios judge whether assets are being used efficiently. Liquidity ratios judge whether the organization can meet short-term obligations to creditors. Solvency ratios evaluate the longer-term obligations a firm has, and profitability ratios provide an assessment of the firm's ability to generate adequate financial returns. In controlling an organization, managers also make critical decisions to centralize authority or to delegate it to lower-level employees. They also decide whether to focus on financial returns and quantitative data or to use judgments to control the organization. Finally, managers control on inputs, behaviors, or outputs based on whether they can be measured and monitored effectively. And that ends the second part of our lecture on Chapter 17 on control, performance, and quality.